Ever feel like the world is ending when you see red arrows all over the stock market? It's a scary sight for sure. But what if I told you that in every major financial crisis, while millions lost fortunes, a handful of savvy individuals made them? It sounds crazy, but it's true. Throughout history, the biggest crashes have also been the biggest opportunities for those who knew where to look. Today we're diving into the stories of people who didn't just survive historic financial meltdowns, but thrived, turning chaos into incredible wealth. We'll uncover their strategies, their mindset, and the lessons we can all learn, because understanding how they won when everyone else was losing might just change the way you see the market forever. Let's travel back to the most infamous crash of them all, the Great Depression. In 1929, the Roaring Twenties came to a screeching halt. The stock market collapsed, banks failed, and unemployment skyrocketed. It was a period of immense suffering. But in the midst of this despair, one man saw a golden opportunity. His name was Jesse Livermore, one of the most legendary traders of all time. Livermore had a knack for reading market sentiment. While everyone else was caught up in the speculative frenzy of the 20s, buying stocks on borrowed money, Livermore saw the warning signs. He saw a market that was overvalued and built on a house of cards. Instead of joining the party, he began to quietly build a massive short position, essentially betting that the market would fall. When Black Tuesday hit on October 29, 1929, and the market plummeted, panic ensued. People were wiped out. But Jesse Livermore, he reportedly made over $100 million. That's equivalent to billions in today's money. His strategy was classic contrarian investing, but executed with nerves of steel. He went against the herd. He trusted his analysis over the popular opinion of the day. The key takeaway here isn't just about shorting the market. It's about having the courage to stick to your own research, even when everyone around you is telling you you're wrong. It's about recognizing when irrational exuberance has taken hold and positioning yourself for the inevitable correction. Of course, Livermore's story is also a cautionary tale. He eventually lost his fortune in later trades, but his 1929 triumph remains a masterclass in profiting from a downturn. Another figure from this era who prospered was Joseph P. Kennedy Sr., father of President John F. Kennedy. His story is a bit different. Legend has it that he decided to get out of the stock market when he started getting stock tips from his shoeshine boy. He figured that when everyone, including those with no financial expertise, was speculating, the market was dangerously overheated. He sold his stocks right before the crash, preserving his wealth while others were ruined. After the crash, when stocks were trading for pennies on the dollar, he used his cash to buy up undervalued assets, laying the foundation for his family's vast fortune. His strategy was simple: sell high, and when there's blood in the streets, buy low. Let's fast forward a few decades to the 1970s. The Nifty 50 were a group of 50 large-cap stocks on the New York Stock Exchange that were seen as solid buy-and-hold investments. Companies like Xerox, IBM, and Polaroid. The belief was that you could buy them at any price, and they would never let you down. Sound familiar? This created a bubble, and in 1973-74 that bubble burst. The market crashed, and the Nifty 50 stocks lost, on average, over 60% of their value. It was a disaster for mainstream investors. But a young, relatively unknown investor named Warren Buffett was just getting started. During this period, Buffett famously said he felt like an oversexed man in a harem. He saw fantastic companies trading at ridiculously cheap prices. While others were panicking and selling, Buffett was buying. He famously invested heavily in the Washington Post Company, which he saw as a wonderful business whose stock price had been unfairly battered by the market panic. He understood that the short-term market sentiment had disconnected from the long-term value of the business. His investment in the Post would go on to make him a fortune. His approach wasn't about timing the market perfectly. It was about recognizing quality and value when it was on sale. The lesson from Buffett is crystal clear. A market crash is a fire sale for great businesses. If you've done your homework and have cash on hand, you can pick up world-class assets at a deep discount. It's not about being a daredevil. It's about being a disciplined, value-oriented business analyst. Now let's jump to a more recent and perhaps more familiar event: the 2008 global financial crisis. The collapse of the U.S. housing market sent shockwaves around the world. Banks failed, credit markets froze, and the global economy teetered on the brink. It was the most severe recession since the Great Depression. We all remember the fear and uncertainty, but a few individuals saw it coming and made one of the greatest trades in history. The most famous among them is Michael Burry, the eccentric hedge fund manager portrayed in the movie The Big Short. Burry, a former neurologist, meticulously analyzed thousands of individual mortgages bundled into complex financial instruments called mortgage-backed securities. He discovered that these bonds, which were rated as safe as government debt, were actually filled with incredibly risky subprime loans that were likely to default. Nobody wanted to listen to him. The banks, the rating agencies, the entire financial system believed the housing market could never fall. But Burry was convinced. He persuaded investment banks to create a new financial product for him, the credit default swap. This was essentially an insurance policy that would pay out massively if the mortgage bonds failed. He invested over $1 billion of his fund's money into these swaps. For years, he looked like a fool as the housing market kept climbing and he had to pay expensive monthly premiums on his insurance. His investors were furious and wanted their money back, but Burry held firm. And then, in 2007, it happened. The housing market cracked. Defaults skyrocketed. The bonds collapsed. Michael Burry's fund made a profit of over $700 million for his investors, and he personally pocketed a cool $100 million. Another trader who made a killing was John Paulson. He didn't have Burry's quirky backstory, but his trade was even bigger. His firm Paulson & Cozier also used credit default swaps to bet against the housing market, but on an even grander scale. In what's been called the greatest trade ever, Paulson's firm made an estimated $20 billion from the crisis. Paulson's success, like Burry's, came from deep fundamental research. They didn't just guess. They did the hard, tedious work of analyzing the underlying assets and realized the so-called experts were completely wrong. They had the analytical rigor to see what no one else could, and the conviction to bet big on their findings. Their story teaches us the immense value of independent, critical thinking and due diligence. Don't just trust the ratings or the consensus view. Dig deeper. So what are the common threads here? What connects Jesse Livermore in 1929, Warren Buffett in the 70s, and Michael Burry in 2008? First, they were all contrarians. They had the psychological strength to go against the overwhelming tide of popular opinion. When everyone was buying, they were cautious. When everyone was selling, they were looking for bargains. Second, they did their homework. Their bets weren't wild gambles. They were calculated risks based on deep research and analysis. Livermore studied market tapes, Buffett analyzed company financials, and Burry read mortgage bond prospectuses. They understood the fundamentals better than anyone else. Third, they were patient and disciplined. They waited for the perfect pitch. Burry and Paulson paid premiums for years before their trade paid off. Buffett sat on cash for long periods, waiting for the right opportunity to come along. And finally, they managed their risk. Shorting the market like Livermore or Burry is incredibly risky, but they did it in a calculated way. Buffett's strategy of buying undervalued, strong businesses is inherently less risky than chasing speculative fads. The key isn't to avoid risk, but to understand it, manage it, and make sure the potential reward is worth it. So does this mean we should all be hoping for a market crash? Absolutely not. Crashes cause real pain and hardship for millions of people. But what these stories teach us is that volatility and crisis create opportunity. They shake out the weak hands and allow the prepared, disciplined investor to acquire assets at favorable prices. The lesson isn't to be a vulture, but to be an opportunist in the best sense of the word. It's about maintaining a long-term perspective, keeping some cash on the sidelines for when those opportunities arise, and never, ever following the herd off a cliff. History doesn't repeat itself, but it often rhymes. The bubbles and crashes of the future will look different from those of the past, but the human psychology that drives them, fear and greed, will remain the same. By studying these legendary investors, we can learn to recognize the patterns, control our own emotions, and perhaps even turn the next period of market madness into a life-changing opportunity. Thank you so much for joining me on this journey through financial history. If you found this fascinating, please hit that like button and subscribe for more deep dives into the world of investing.